Happy New Year. Today I'm joined as usual by Randall Janicki, who is Head of Australian Equities and Portfolio Manager for the MIQ Australian Equity SMA. A pretty tumultuous year last year. How did the quarter finish for Australian equities?
So the last quarter was a very strong quarter. So you saw the Australian equity market increase by close to 9.5%. And that's for two key reasons. One was we had quite a strong bank reporting season. So results came in better than expected, and so the banks and financials did well. But the real story towards the end of the quarter was the China reopening, which certainly happened a lot faster than the market was expecting. So as a result, you saw that markets lifted, and in particular, it was the mining stocks that really led the way and outperformed during that December quarter. Right,
and so as we sit here at the start of 2023, what are the types of things or the signposts that you're going to be looking for Australian equities this year?
So this year I think is going to be a really interesting year, probably going to be a bit more nuanced than we saw last year. Last year was all about inflation and rising rates, whereas this year it will be a story, I think, of inflation still bubbling away but coming down and I think getting under control. The question is, where does it settle? And therefore, how much further do rates need to rise? But I think the key driver that's really going to matter to markets is going to be earnings. As economies slow, earnings will come under pressure, and I think that will be the thing ultimately that will dictate what sort of year we have. So we are on the cautious tack. We do think that earnings will probably disappoint, which we also think will create lots of opportunities. But I think earnings will be the dominant driver for 2023.
I've heard you talk previously around potential earnings recession. Whether we head into a recession or not in the economy is probably less relevant. But how do Australian investors think about positioning their Australian equity portfolio in an environment of slowing earnings?
I think you want to be cautious in terms of companies where cyclically they could come under pressure, particularly where valuations aren't supportive. So we think you still want to be more defensively positioned in companies where valuations look attractive. So we would point out, some companies in consumer staples. If you think about Coles, for instance, Treasury Wine Estates, some of the healthcare names. But I think also this year could be the year of the revival of the fallen angels. So we saw a number of growthier stocks last year that were down 30, 40, 50%. And I would say that particularly in the first half of this year, if there's further weakness in those types of companies, we think it's a great buying opportunity. So there will be shorter term earnings challenges, but I think there's going to be lots of opportunities to really set up your portfolio for the next 2 to 3 years as well.
Yeah, great. I think investors are definitely looking for a more positive year this year. Well, thank you, Randall. And thanks everyone for your interest. If you've got further questions around the T. Rowe Price Australian Equity Fund and the role we can play in your client's portfolio, please reach out to your local T. Rowe Price representative. Thank you.